as the rate of monetary inflation increases, it skews the entire playing field, or it tilts the balance of power.
No banks, no fees, no inflation. These are the potential perks of this thing called Bitcoin.
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 Bitcoins.
Bitcoin.
Bitcoin.
Bitcoin. Bitcoin.
This week's profitable moment would be very profitable if you had invested in Bitcoin.
For the past decade, the cost of capital was about 7 to 8%. And companies that can't grow their cash flows greater than 8% were destroying value.
In this video, Michael Saylor speaks on why companies and corporate treasuries are going to keep coming and coming and coming for Bitcoin. Bitcoin has gone over 60k a few times today, so congratulations to all holders in the green. With the Coinbase IPO now announced for April 14th, it looks like we are in for a big month. Make sure to stick around to the end of the video where we go over one piece of recent Bitcoin data that suggests where the Bitcoin price is likely to go from here. Also, only a tiny percentage of my viewers are actually subscribed. If you enjoy the video, consider subscribing. It's free and you can always change your mind. Enjoy the video.
Somebody said, 40% of all the money, printed in the first 240 years of the country, right, got printed in the last 12 months. If we start with a fundamental premise, the fundamental premise is that as the rate of monetary inflation increases, it skews the entire playing field, or it tilts the balance of power. So as a corporate CEO, looking at it with the lens of a company officer, what I see is, for the past decade, the cost of capital was about 7 to 8%. And companies that can't grow their cash flows greater than 8% were destroying value. And that drove most companies to either take on obsessive amounts of debt or oppressive amounts of debt. They borrow lots of money to buy their stock back, and they destroy their capital structure and their balance sheet, and that drives them to insolvency. Or they borrow lots of money to issue a dividend, and that drives them to insolvency. Or they borrow money to buy other companies to do these crazy acquisitions, and those are dilutive acquisitions where they're doing roll-ups, and that eventually drives them to insolvency or blows them up. Or they issue equity to do acquisitions, the classic dilutive acquisition. And they were all driven out of business. They all basically ended up selling out. If you look, 99 out of 100 of my competitors exited in a decade. And the story was always the same. My shareholders expected us to grow 20% a year. We could only grow the company 8% a year. And so we started buying other companies, and we kept buying them, and we got all their headaches. And eventually we realized that we couldn't do another acquisition, and we bolted on 47 other companies. And so we decided to sell ourselves. And I said, well, why didn't you just run the business, which was a good business? It was organic. Well, I couldn't get the growth the shareholders wanted. Well, why did the shareholders want the growth? The shareholders wanted the growth because the cost of capital was 8%. Well, why was the cost of capital 8%? Well, because the Fed kept expanding the money supply by 6% a year. What would have happened if the money supply expanded to 0% a year? The cost of capital would have been 3%. Those businesses wouldn't have had to do all the dilutive acquisitions or leverage up or issue all the dividends or or buy the stock back. They would be in business. So what you have is as we crank up the cost of capital, we crank up the hurdle rate. We drive people to take on more risk, to do more, to go faster, or we make the capital toxic. Like, I have $100 billion, but since I'm generating 0% yield, I'm destroying $20 billion of purchasing power a year. The pressure from the shareholders is give all the money back. Well, this is like draining the endowment from a university. This is like me saying to you, you have to give all of your money away in your family because you're destroying value. And so you give all your money to charity. And then when your child needs to go to the hospital, you can't afford the hospital bill. The family starves. Kids can't go to college because you've decapitalized. And so that's the challenge right now from a corporate point of view. And to make a long story short, the problem with the $350 trillion of assets is they're all based upon an expectation, in part or in full, on an expectation of future cash flows. And you're discounting the cash flows back to the present. And the single most important variable is what's the discount rate? And the discount rate is really being driven by the rate of monetary inflation. Let me say it a different way. The K-shaped recovery. That's Wall Street recovering and Main Street never recovering. That's the K-shaped recovery. Actually, Main Street is worse off today. Wall Street is better off today, right? If you're actually an operator of a business and you're honest, there's no way the economy is as good today, right? Like, for example, business travel is down 95% year over year, and success will be, it'll be down 90% forever, right? But nobody wants to talk about that. So when we inflate the money supply by 24%, that means that on Wall Street, people that own assets did nothing to make 24% more money. And that means on Main Street, people that create things for a living, that manufacture things, had to work 24% harder to get nothing, right? You literally tilted the football field, and everybody on the manufacturing side that works with manual labor and has to do things, if you generate cash flows, you have to generate 24% more cash flow after tax by raising your prices or by expanding your customer base or by finding efficiencies. You have to do 24% more to have the same purchasing power that you had a year ago. And on Wall Street, if you own that asset, you had to do nothing. You could have sat in your floaty in your Hampton swimming pool and watched the stock market, and you would have 24% more purchasing power, as long as you didn't touch anything, right? And so that is the dichotomy. If you have a Main Street personality, and if you have, and that exposure, and if you have the sensitivity to understand what's going on as an investor, right? It clicks like a light bulb. And I was in that fortunate situation because on one hand, personally, I was a successful, engaged investor in technology. I owned a lot of Apple, Amazon, Facebook, Google. I basically invested in tech stocks, and I watched what happened, and I understood what was going on in that world. And then in my day job, I'm running a Main Street operating business with 2,500 people doing 100,000 things perfectly every year, right? Every year I'm doing 100,000 things perfectly, competing against everybody under the sun, and we're generating this cash flow. And the investors are looking at me thinking, you seem to be utterly failing because your cash flows didn't grow by 25% like Google last year. I'm like, well, actually, there's 2,500 brilliant people working as hard as they possibly can, to keep the cash flows from going to zero. And so if you understand Main Street and you understand Wall Street, then what you see is that if the money supply expanded at zero, then you can actually run a business that generates a lot of cash and it has value. And when the money supply expands at 25% a year, everything your business has no value except unless it grows. Well, I guess another way to say that people might understand is, if I told you every human being on earth that can't get a 25% raise every year for the next 20 years should lose their job and is worthless, you understand the problem, right? Like, we're all worthless. I mean, at the end of the day, the only thing that's left is robots doing everything. You have a certain moral hazard at some point. And where does that happen? Well, if you want to see what happens in the extreme, if you don't fix the problem, Venezuela, Zimbabwe, Weimar Republic, a collapse of the currency. Any country where the currency literally collapses 15% a year, what happens is eventually the money is worthless, the economy breaks down, and then no strategy, no business, no investment portfolio, bonds, stocks, real estate, nothing will hold value because the currency is rendered utterly toxic. And if the currency is toxic, we can't commerce. We can't commune with each other economically. So that's the challenge we face, and you have to react to it.
So there's Michael Saylor on why companies and corporate treasuries are going to keep coming for Bitcoin. Now, for a recent piece of Bitcoin data, some very interesting data out from on-chain analyst Sentiment, we have some data out regarding Bitcoin whale transactions. What we can see happen over the last 12 months is that transactions worth over $1 million is up over 740% over the year. This is a huge show of Bitcoin's utility, and although we won't ever see users on the Bitcoin blockchain using Bitcoin for small purchases such as buying a cup of coffee, a great argument can be made for BTC for huge transactions and the minimal relative fees that it requires, no middleman needed. Definitely some interesting data to think about, especially for those skeptics who aren't a fan of Bitcoin as a transactional tool, but rather solely as a store of value. Let me know what you think of this on-chain data in the comments. I hope that provided you guys with some value. I'll see you in the next video, and as always, have a great day.